It's Brad the Humble Trader again. Last week I showed you many charts why I think this is a new bull market, and it was a long post, so I'm sorry about that. So I'm going to try and keep this one shorter. I've only got about 8 charts to show, but in this one what I'm going to do is show Fibonacci retracements. So we've had such a blast up from the February lows that I know people are going to think that they maybe didn't get a chance to get in and they're concerned. But this week I'm just going to show what I think the potential to Fibonacci retracements could likely happen, and show the sort of the past from the 09 bottoms and what typically happens in terms of retracements. So I just want to get started with this chart here. Now this one, I've shown this one before, but I just highlighted a price a little bit so it's easier to see. I know a lot of people are going to say that we have these negative divergences, so we might be topping out here, and definitely, you know, we've had a good strong run up and we were short time overbought for sure. So this is definitely pretty obvious that we're going to have some sort of a pullback here. So how far are we going to pull back? That's the question. So let's look at now the reason if you didn't see last week's post, the reason why I think we're in a new bull market, there's a few things. On the daily chart, the 50 has crossed the 100 EMA. On the weekly chart, the 20 has crossed the 40 EMA, which is very bullish. Doesn't happen very often. So, and also you got price above the 30-week moving average on the weekly chart. You know, price has broken some of these resistance levels, not the top, not the highs so much, but some of these channel resistance levels. But so yeah, how far are we going to pull back? So let's look at history and see what happens in a bull market. Also, in terms of the negative divergences, if we go back to the 09 bottom, for example, I mean, there's a negative divergence there also, and it only pulled back down to the 50 and 100 EMAs. So you know, just because there's a negative divergence doesn't mean necessarily that there's going to be some sort of huge pullback. And also, just so you know, I mean, even though I'm bullish, it's not to say if this market starts to roll over and make lower lows on the daily chart, and then start to make lower lows on the weekly chart, then obviously I will change with it. But right now I'm bullish because all the markets are showing that it's bullish. So okay, so let's look here. So I think what we need is, if you look back at these past couple of instances after the 50 and 100 EMA cross, one here after this EMA cross in 010, and the one after 11. You know, we've got basically the MACD comes down and resets to 0, as does the RSI in both instances. 2010. 2011 is a little bit different. I'll show it a chart, and I'll show you what we may need in order to sort of reset these the momentum indicators. But because I think we're at the start of a new bull run, I mean, we could go to new highs and then roll over into a bear market, sure, but right now I think I'm just assuming that we're at the start of a new bull run because the 50 has crossed the 100 EMA. So I know that we didn't have a crash like the 08 crash, but if you look at sentiment, these lows here after this, after the end of 2015 to start of 2016, I mean, the sentiment it was quite an extreme sell-off, even though in price it wasn't that big a sell-off. So okay, so obviously what first thing we're looking for is the momentum indicators to reset at 0. They could overshoot it, but if you look at these 3 times that I'm indicating here, price pulled back to the 50 and 100 moving average, price pulled back to the 50 moving average after 2010 and after the crossover. And after the crossover in 2011, a very strong run up, and it only didn't even pull back to the 50 until we had this sharper sell-off. So which one is it going to be? Good question. So, but what I'll do is I'll go over each three times and quickly show. Okay, so this is the 09 line. Okay, so we had a nice strong run up, a lot of short selling, and we had a pullback to the 23.6 Fibonacci retracement, which is obviously just after the crossover, which is what we're indicating right now. Okay, so even though we've had the strong up in this market right now, we're expecting some sort of pullback, and the next entry is going to be the big thing. When are we going to get back in? So once we have a three-wave correction back to one of these Fibonacci retracement levels, then we break, sort of do a resistance line here. Once we break that, that's a perfect entry. I mean, if we're above the 200 moving average, we're above the 50 and the 100, and it breaks resistance after a correction, perfect entry. I mean, it's the best time to get in. So that's the sort of thing that we'll be looking for. And after that, you get a nice 20. I mean, if you just, I mean, your exit will be up to you. How you exit's up to you. But in the future posts, I will do how I exit, but not in this post right now. I'm just assuming going from that 50-100 crossover again to the downside. And that's a 25% move in the SPY, SP 500. So the 2010 sell-off after the crossover. So if we look at the Fibonacci retracement, once again, it retraced 23.6%. As another good entry, we just put a little resistance line there. Once it crosses back over to the upside, then you get another good entry. And assuming once again, I just go off the 50-100 cross to the downside, and the break of support there, then we're looking at about a 9% S&P 500 run. So if we go to the 2011 sell-off, so this is where it gets a little bit trickier. This is a perfect setup here. You got a nice strong run up, you get a nice three-wave strong correction, and it would have definitely shaken people out. But excuse me. All these choppy movements here gives a perfect setup to enter after this crossover. Okay, you get a nice obvious resistance line there. You've got the crossover. Once it breaks there, you're above the 50 and the 100. Once it gets above the 200, even better. So you've got a really nice setup entry there. But the problem is, we don't in today's market we didn't get this retracement, and that's the issue that I've had. I was expecting, once it came our market, which is today's market, once we got up to the 200 moving average here, I was hoping for a nice retrace like in 2011, which will give us a nice resistance line to trade off, but that never happened. But before I go into today's market, I just want to show the retracement levels. See, here we don't really get a pullback to enter. If you're not in there, which is a perfect entry, in a normal situation you'd be in there and you'd run the course. But if you're not, then you don't really get a chance to get in. So, but after the 2012 sell-off, you probably get, I mean, it didn't really cross here at all, the 50 and the 100, but it definitely does give you a better entry to get in again. Anyway, this just goes to show that no matter how strong the market is, you always get another chance to get in. So let's look at today's market. So from the February lows to the high here, I mean, look at it. I guess the only chance you really had to get in is, I mean, I don't know whether you call this, it's not really double bottom, but either way, you've got some nice resistance there. And once it broke there, that's your first entry. But other than that, you really haven't had a chance to get in unless you just get in at any time. Which is not how I get in. I need some sort of resistance lines to get in. Also I was waiting for the crossover of the moving averages, and I was waiting for price to rise above the 30-week rising moving average, which has only just happened in the last few, well, I think it was about 6 weeks ago, but not much has happened in the last six weeks so much. Hasn't really given us a good entry. So I think we've got a good entry coming up. So what sort of thing are we looking for? I think if this price movement here is this price movement here. I think right now what we need is a nice just 3-wave corrective move. As 2010 and 2009 showed, the retracement levels pulled down to the 23.6 now, which is 23.6 off this run is this level here, which is down to around about the 50 and 100, which is a good setup. But I wouldn't just get in, you know, because unless it's a bigger sell-off. What you really need is draw a little retracement line off those little highs, the little peaks there, the corrective move, and then use that entry as an entry to get in. That's sort of thing that I'll be looking for anyway. I think I've covered just about everything there. As I said before, there's possibilities that can roll over to a bear market. That may be the case, but I just don't think that's going to be now. But I want to show you this article. I mean, everybody should look at financial sense. I don't look at fundamentals at all, except for this site. The articles on this site, a lot of them are fundamental, and I don't read them all, but what I do take into consideration are people who talk about fundamentals but follow it up with charts. Chris Paplava is one of those people. He writes some great articles. So this is This Week in Financial Sense. If you have a look at his warning of the potential for a new recession and a market top, but saying that it may not happen until next year, go and have a look at this article. Some really good charts here that show the potential for a much bigger sell-off at some point. You know, I'm open to anything. Definitely could be a bigger sell-off, but right now, until it proves otherwise, it's, in my mind, it's a bull market. So let's just go to commodities. So right now I'm going to show you the Dow CRB Commodities Index, the relative strength chart. Okay, so if you can see here, every time, so when this relative strength price action goes down, all that means is that the Dow is weaker than commodities, as you see here. Okay, the Dow was weaker than commodities here. When it goes up, this price action has broken the resistance. Okay, they're both going down. It doesn't matter. This is not a directional thing. This is just what's showing one's stronger than the other. So they're both going down here, but commodities is stronger. Sorry, I should say the Dow is actually weaker on the downside than commodities. And once again, up, we've got a stronger run up in the commodities. And Dow, we've got the Dow is weaker than commodities in this region here. The Dow is stronger than commodities in this region. We've just broken to the downside again, which means that the Dow, or the stock market, is weaker than commodities. Up or down, it is weaker. And right now, obviously both markets are trending up. So either way, if you're going to be going long, you want to be long commodities if you have a choice over the stock market at this point. And I'll quickly show, let's go to silver. And 2 weeks ago I showed why silver is a good trade. I mean, if you look at the silver to gold ratio, go back 2 weeks ago and you can have a look at that. I showed some good charts. What I want to show is with silver, what am I looking at here? This is okay. So this is the 2009 start of the bull market in silver. I just want to show what were the sort of the similarities, comparisons from then to now. You know, if you're going to be look at history with a bull market, you only want to, if I think it's a bull market now, which I think it is in commodities, then I'm only going to look at price action from a past bull market. I'm not going to look at a bear market because they act and behave differently. So what we had here, we had one run up, we had a corrective action here, and we had another run up. Okay, that took 4 months. And we had a three month retracement. This run up here is a six month run up, and we have a 3 month retracement. 4 month up, 3 month retracement. Okay, so these are the kind of figures in terms of time. These are the kind of time limits that we want to sort of keep an eye on. It's the potentiality of it anyway. Right now we've had a 4.5 month run up. I'm definitely not saying to get out of silver. I'm just saying that it is getting quite toppy. I mean, I wouldn't say toppy, but it's had a really strong run up, and it could go for a lot longer. But whenever you look at getting out due to however you get out, then I'm just looking at from a retracement point of view. Anyone who isn't in, is looking to get in, you want to start looking for these sorts of things. So I'm not just saying get out of silver if you're in silver, but if you're not in, you want to look for these sorts of this sort of retracement. Okay, so we've had 4.5 months up. We're getting up to this resistance level here between those two. So if you go back to 2009, we had a similar sort of setup. Okay, it rose above those, just above a fake out, and then came back down to a 3-month retracement. And if you have a look at the size, these are called speed lines. So the run up here, and you follow it up here, it went a little bit longer than that first run up. Okay, and I did the same thing here, and that's already a little bit longer than the first run up. Okay. In terms of Fibonacci retracements, okay, so this run here, the second run up, excuse me, the red line is a 62% retracement of that run there. And if you look from the bottom to the top, I haven't got the retracement levels there because it's too many lines you can't see, but from here to here, it was a 50%, this green line here was a 50% retracement. So between those two, you've got between the 62 in that run and the 50% on the full length run, then we're looking for that sort of retracement in silver. So if you look at today's market, same sort of thing. Okay, from this run up, and I'm assuming that it's going to get up to at least silver to this resistance. Okay, so I'm just assuming that it could go higher. But if it does, and it retraces from that point, we're looking at around about the 16, around about, what is it, 1620 to 1660 sort of level retracement. And I've also done the lines. This blue box here is the same, what is it, the 50% retracement from this run here to this run here, or the 38 to the 50 is this run here. So we're looking for around about this sort of level retracement in silver if it tops out at this sort of point. Okay, remember it's excuse me, it's already been 4.5 months, so it has the potential to sort of retrace at some point. It can't keep going up forever. Another thing to look at actually quickly. This chart here, we've got the commitment of traders for silver, okay, and I've just drawn on there each time. If you have a look here, look how the commercial traders are hedging silver, and they're at their greatest hedge or net short than they have been since 1993 on this chart. Okay, that's huge. So if you look at it from the other point of view, the large traders, they're heavily net long than any other time in this chart, and this is a monthly chart, right? So it doesn't necessarily mean that it's going to top out here, but it's higher than any of these points, and this is in a bull market. I'm only comparing it once again to a bull market in silver. So I'm not saying that it's going to top out. I'm saying that when it does, that these people are heavily net long. They're usually wrong at the wrong time. So just keep an eye, though. There's going to be some sort of retracement at some point, and if you're not in, you'll get a better entry shortly. Excuse me, probably within after approximately a 3-month retrace. Those are the things to look out for. If you're not already in, I think in the market you will get a pretty good opportunity soon. Same as in silver. If you excuse me, if you're not in, then with silver I think we'll get a pretty good opportunity in the not too distant future. But if you're in silver, hang on for sure, because commodities are very strong. Same as oil. I didn't do oil, but I mean this would be a good opportunity for you. Pull up the chart of oil, go back to the start of what you think is a new past start of a bull market, and just have a look at the retracements and see how long the runs up are in time, and go from there. Okay guys, thanks for watching. I'll do another post next week, and I'll talk to you then. And just remember guys, this is just, don't trade based off what I've shown you here. It's just things that I look out for. Thanks guys, bye.